Namaste, Har Har Mahadev. So, past few days I have uploaded a video based on global markets. So, this video is also going to be the continuation of that global market video. In that, I have explained what are the global markets, and as discussed in that video, I have a consolidated PDF of that. If anyone needs that, you can mail me. I'll email you the consolidated PDF all of entire global markets. So, in this, I'm going to discuss how global indices or how global markets or sentiments, a few sentiments affects Indian stock market. So you'll find there are many who will just draw some horizontal, vertical lines, trend lines and all on the Nifty, Bank Nifty, Fin Nifty, wherever they want, and just by drawing those a few tools, they think they can trade. They may trade, but if you want to be a trader, trading is all about exploring. You should be aware what is going on the any world's corner, the financial situation. Every dots are connected in trading. The political issues, non-political issues. So currently, before yesterday, the India and Canada clashes is going at severe level. So both the nations have deported their diplomats in their own countries. Now the Indians living in Canada are in extreme pressure, and there are somewhere we have heard that maybe there is a Indian government is again to launch a mission to bring them back. Whatever, some mother.gov.in website is launched. So these things are clearly connected to stock market. If let's say if any stock associated to that or something, some sector is going to be different, the company who are doing very good in Canada, if their owner is Indian or their owner were Indian, definitely that stock is going to suffer because due to Indian and Canadian clashes. So yes, global market plays a major role. I was looking for some very good content, but I got one today, so I thought to make this video and upload it for you. So what are the things what are the things that affects the Indian market which are global? Okay, so let's quickly jump to that. So I got this very good article, and they have explained not everything but a few things, but these few things are more than enough for you all. So I'm not going to read all the things. If you want, I can give you the link of this in the description, the article I am referring. So they have highlighted the points like dollar index, US treasury bonds, crude oil. So I'll just pick one and explain you. There are 5 to 6 points, and it's not more than enough, but at least you will get a glimpse know how such thing affect Indian markets. So from last 3 to 4 session, this market is continuously falling. So in Nifty made high of 20,200, and now it started falling badly. So just in 3 sessions it came to 19,600. Today is Saturday. Yesterday it closed around 19,640. So in just 3 days, in 3 sessions. So let's understand this global market. The dollar index. What is dollar index? That is DXY. The big players always diversify. Well, this video is gonna be long. It's gonna long, but you'll end up learning a lot of things. So stay tuned. So dollar index, that is DXY. Dollar index. Let me see if I can show you the DXY chart. What is this? Okay, DXY. Yeah, I'm on monthly chart. Okay, so this is daily chart. If you see dollar index is in strengthening day by day. It's keep on strengthening. So what big player do is, let's say I have to invest 100 rupees. I have, let's say not 100, that's just very small amount. I have 1 lakh crore rupees. Okay, I'm a hedge fund sitting anywhere in the corner of the world. I have 1 lakh crore rupees. I'm talking about Indian rupees. I have 1 lakh crore and I have to invest. So definitely I'll not invest this entire 1 lakh crore in any one single market. I will diversify this, whichever is weaker or whichever index has in anywhere in any part of the country, whichever index has corrected itself, I'll go to invest in that, because if correction is there, I'll check the sentiments and the fundamentals, what were the reason for the correction, and then I'll start investing in that country. Likewise, now dollar is DXY dollar index is strengthening day by day. So if you see, the low was some $99 in July. Now it has reached to $105. So let's say any hedge fund or big player or FII of United States is saying that no, my own currency is strengthening. So why should I not invest in my own country? He or she can say that. Any hedge fund can say that. So what they will do, if they see or predict anywhere's global, any country's market is going to crash, not crash, but if they see that if my own currency is strengthening, it's good for me to invest in my own country. So what they will do, they will start taking out their diversified funds from other countries' market and start investing in their own. So whenever this dollar index strengthening, since US is a developed economy, so whenever FII has invested their money in Indian market, India is an emerging market, it's not developed nation still. So what they will do, they will start taking out the money from Indian market and start investing in dollar index in US market, because DXY is strengthening, anywhere's currency is strengthening, so they will start investing in that. So that is one dependency on dollar index. I'll read the line. Dollar index is one of the macroeconomic element that has significant impact on the Indian stock market. Currently I'm talking about only Indian stock market. Generally there tends to be an inverse relationship between the dollar index and Indian stock markets. Inverse means if one increases, the other goes down. So if DXY is increasing, the Indian stock market will go down. I'm not saying this is the sole reason why Indian stock market, the Nifty, has fallen consecutively 3 days. There could be multiple reasons, let's not talk that right now. But if dollar index is strengthening, the relation is inverse, and definitely the Indian stock market will go down, because FIIs will prefer to take money out from Indian stock market and invest in US stock market. The reason behind this is that when the dollar index falls, FIIs, when it falls, the FIIs invest more in Indian stock as they give higher returns as compared to returns from the dollars. Now what is this? So if dollar falls, the INR, Indian rupees, increases, INR rupees value increases. So currently it's this INR is trading. Let's check the INR as well. Yes, the INR. I hope you are able to see my screen. Yeah. So if you see, currently it's trading at 82.90. Why? The dollar is strengthening, so INR is, this Indian rupees is decreasing. Likewise, when DXY, the dollar index, falls, this Indian rupees started strengthening. So in that case, the FIIs prefer to take money out of US stock market and invest in India, because this Indian stock market is giving higher and smooth and smart return. So that's what it says. Conversely, when the dollar index strengthens, the Indian stock market may witness pain due to FIIs outflows. That's what is happening, because DXY is strengthening. So whenever this huge candle in DXY forms, whenever this huge candle in DXY forms, Nifty has always bleeded. Even Indian stock market has bleeded. Even I can compare this. Okay, I'll show you the comparison as well. So see, here DXY was falling. Okay, so let me show you how I have done this. So in trading view, this is free version, I have free version. So in trading view, we can put this chart. So this is DXY chart, and if you want to compare any index, so the base is DXY dollar index, and if you want to compare any index across the globe, you can just go to this plus sign where we choose the index. So this, go to compare and add symbol, if you can see. So if you can go there and you can select any index if you want to, whichever you want to compare. So the index you are going to compare will be highlighted and it will be in line chart. So I have to compare Nifty. So I have selected new price scale, and now see. So the DXY was falling. Here if you see, it fall from 103 to 99. The Indian stock market made new high. So it was 19,497 to how much it was 19,740, and then it went till 20,200. So whenever DXY falls, it does not mean that whenever you see DXY is falling and you went and short Nifty. No, it's not at all like that. I'm just giving you an example, the dependency of your Indian stock market to US stock market. That's it. With this you can get an idea. So see here, DXY was falling and Nifty were making new highs, and whenever this, see, the DXY started strengthening, now the Nifty has fallen. But if you see, DXY started in strengthening from 14 July and Nifty started its fall on 15 September. So yes, there is a lag, no one can time the market. So the DXY dependency you have understood. Let's go to the next, US Treasury bonds. So what are these Treasury bonds? Even the yields, bond yields. The bond market of United States is much bigger than stock market, because bond market is safe money, is completely safe. Any money brought to India in stock market, wherever it is a risky money. Stock market is a risky asset because here is nothing is guaranteed, but bond market is guaranteed. So there people play safe. The money is safe over there. That's why wherever there is a huge action, or if you see the bond, the yields as in the percentage return giving on bonds, that is yields. So whenever the yields is increasing or yields are decreasing, so whenever yield started increases, that means bond market is seeking more money, they are asking for money. Whenever yields started decreasing, so their demand is high, that's why they reduce the supply. So when the yields started decreasing, it means they have the enough money now, so the yields are increasing. That's why treasury bonds is there. Let's read the line. The US treasuries are one of the safest investment avenues and attract massive flows from investors all across the world. That's what it says. If you talk to your grandfather or your father, if your father is born in 1960s or 70s, he'll always prefer, yes, his views may differ, but they will always prefer to put money in FD. Why? Because there are fixed returns. It's not dynamic. The returns, which whatever 6%, 7%, 8%, that is fixed return and is guaranteed. That's why always those who want to play safe, they put their money in FDs and the bonds. And rising yield indicates an increase in borrowing cost of business, which discourage future capex expansion plans, and their interest expenses increases. So what is rising yield? Rising yield, that I told you, the yield means the percentage return on the bonds. So if yield is rising, if I want more money, what I'll do, I'll start giving more returns as in more percentage. For example, let's understand with this, I'm a bank and now I am giving 5% return or let's say 8% return on a 10-year bond. Okay, I am giving 8% return on 10-year bond. If you give me your 1 lakh rupees for 10 years, I'll give you 8% annually. But if I am seeking more money, I'm talking about bond, okay, it's a FD bond, not stock market. So now I am giving 8% return on 10-year bond, but I am seeking more money. I'm running less of money. So what I'll do, I'll start giving 8% return on 5-year bond. I might start giving 7% return on 3-year bond. Why? I'm giving greed to retail investors. No, come and give me the money. I need money. That's why I'm giving you more return. So a rising yield in bond market shows the money. And what happens is, just imagine like this: if any bank or wherever, if that bank was giving 8% return on a 10-year bond, what happened? What has happened to that same bank is giving same 8% return on a 5-year bond? They're saying, come give us money only for 5 years, I'll give you the same return on which is on 10-year bond. Why? Primary reason, they are seeking money, they want money. Any retailer will think, now okay, I'll get my money just in 5 years, so why should I go for 10-year bond? They're giving the same return. And sometimes it has happened, I'll discuss that in some other day. Sometimes it has happened the same, like 10-year bond has given same return on 2 years bond. So if 8% return is being given on a 10-year bond, the same return will be given on 2 years bond. So bonds are like minimum 3 months is the security period. So there is 1 month also, but I'm talking about bonds, the treasury bonds. So there will be minimum 3 months. So you have to keep your money at least for 3 months. So there are multiple comparisons. So 2 years, 3 months, 10 years, 2 years, 10 years, 5 years, like these. So whenever the bonds companies started giving more return or same return on less tenure bond, less time bonds, that's a clear indication that they are seeking money, they are seeking more money, they are running out of cash. So that's what we understood from treasury bonds. So I have read this line. Thus there tends to be an inverse relationship between treasury yields and stock markets. Again, if treasury yields are increasing, if bond yields are increasing, definitely the money will come out of the stock market and goes to the bond market. I'll explain this as well. So imagine I have invested in one stock, my 10 lakh rupees, and yes, the stock market can give me, I have invested like for a long term for 5 years. Okay, I have invested for 5 years, and now I see that stock market is giving me fixed 8% return in just 5 years. Fixed 8% return. Whoever is a bit intellectual, he always aim for 10 to 15%. It's yes, the stock market has potential to give you 10x, 5x or 2x. Let's not go in more greed. It can give you 2x. Your 10 lakh could be 20 lakh. Your 10 lakh could be 25 lakh, 30 lakh. It has potential, but it is also potential. Your 10 lakh could be 1 lakh. It could be 1 lakh. I'll just show you with an example. There are many I know who invested in Tata Power in 2008. Sorry, I opened the wrong one. It's gone monthly chart. Now see, in 2008 it was 57 rupees and it went up to 145 rupees in 2021. So more than 10 years, more than, if you invest here, let's say it's a crash, yeah, 2008 recession, the crash. So if you have invested there, definitely you would have get very handsome return. But if not there, let's say you have invested in 2014, the Tata Power was running around 110 and your money was at same level till 2021, till COVID, and in COVID even went to half, 28 rupees. So you invest at 108 rupees in 2014, and after 6 years your money was half. So stock market has such phases also. But if global market is giving, the bond market is giving same guarantee 8% return, definitely a fearful investor or a normal who doesn't have that much idea about stock market and things, he'll definitely take out the money from stock market and invest in bond market, because that's a safe return. Everyone wants to play safe. That's why when the yield increases on bond market, the money always started coming out from stock market and goes in bond market. So that is second point we have discussed. The third is crude oil. Crude oil, that's the biggest impact, and I'll show you the crude oil graph as well. So India is a major importer of oil, as more than 85% of Indian domestic oil requirements are met through imports. India is, I guess, third or fourth. I'm not sure, second, but it's in top 5. Top 5 is second or third or fourth, I'm not clear, is the biggest importer of crude oil. Biggest. So because all our domestic industries and things are purely dependable on crude oil. Industries like tires, logistics, refinery, airlines, lubricants, paints, etc. are directly affected by a change in global crude oil prices. So whenever crude oil prices hikes, definitely that industries goes down, their stocks goes down. So Asian Paints is the paint, airlines, IGT, Indigo, and tires, MRF, TVS, Apollo tires, logistics. So the one who the freight carrier, they faces the impacts, their stocks goes down. So whenever there is a crude oil rise, I'll show you the crude oil also, it's went from some 5000 to 7500. I'll show you in very short period of time. Again, I'm on monthly chart. Let me show you. Are we connected? Let's check that. Yeah, connected. So just see. So in June we were at 5500 and now we are 7400 in just 3 months. So imagine the intense pressure on industries which are purely dependable on crude. So let's check if we have some impact on, I'll just take example of Apollo. If the stocks has gone down, so it rise from June, so yes, there was a downfall, but now see the fall. It's not solely due to crude oil highs, definitely there could be some other reason, but out of all the reasons, one is crude oil, because crude oil prices surge badly. Okay, let's check the other. Yes, Nasdaq index and Indian IT sectors. So Nasdaq has comprises mostly of the IT stocks. You can select the stocks associated or stock list Nasdaq. You can search this simply and you'll get the stock list of Nasdaq. So Indian IT sector is purely dependable on Nasdaq. We can say that not replica, but it follows major time. It follows the Nasdaq Indian IT sector. Now, what are the stocks associated to that? I have explained that in sectors, Indian market sectors. Infosys, Tech Mahindra, Wipro, TCS. These all are the major IT companies which have their majorly business in United States. So whenever there is a fall or recession or whatever in US stock market or Nasdaq, definitely these stock has bleeded. So last year, let's see that on graph. So I'm opening Nasdaq. It's a daily chart. So 2000, okay. So this is January, okay. Let's see the last year. So Nasdaq has suffered badly. So in January 2022, it corrected 40%. It fall. So from 15,000 it came to 10,000. Okay. Now on the same chart, let's see if we can compare. Let's compare Infosys. See, you can call it even replica. So we were here on January 22. I'll draw a vertical line. So see the fall. Nasdaq started falling. Now see how Infosys has performed, falling. So we can call it exact replica. So that's the dependency of Indian IT sector to Nasdaq. You see, let's check for TCS. This one looks exact replica. Let's see. These things looks a bit odd, but yeah, you all can understand. Now see. So this is Nasdaq. It's like following the same path, exact copy. So if Nasdaq has fallen consecutive for a week, the same stock has also fallen. This is, by the way, TCS, Tata Consultancy Services. See. So that's how things depend. Now let's go on other sectors. So SGX Nifty, the Singapore. The SGX Nifty, which is a Singapore based index, indicates how the Indian stock market is likely to perform on the next day. Well, that's a myth, not myth, but there are many who trade based on this. This SGX Nifty has now become Gift Nifty. It's not SGX anymore. So this is Gift Nifty. There are many. They say like sometimes they see if SGX is fault a day prior, it would they'll sit for the put position or short the Indian Nifty or Nifty, mostly Nifty, which follows the Nifty. So this huge depend on it's huge. The Nifty is dependable on this gift Nifty. So it is essentially a future contract based on Nifty 50 index, which is India's benchmark stock market. Yes, SGX is future. It's the SGX Nifty, the gift Nifty derives its future value from Indian stock market Nifty. The SGX provide investors with an early indication of how the Indian stock market is likely to perform, allowing them to make more informed investment decision. Okay. So next is Indian ADRs. This is important. There are two things, ADR and GDR. ADR is American Depository Receipt and GDR is Global Depository Receipt. Now what these two things are, any Indian stock which is being traded in America comes under ADR, and any Indian stock which is being traded in Europe, that comes under GDR. So I guess last month or in July, I'll show you the Infosys, because Infosys is being traded. There was a huge gap down in Infosys. Yes, this one on April, either this one or this one. I guess this is July. Yeah, July. Sorry, this one. I'll remove the drawings. So this is Infosys. Infosys is an Indian IT stock. So it opened gap down of around 6%. That's a huge 1300 rupees stocks opened 6% gap downs on 21st July. Why? Because Infi GDR, yes, I guess GDR. Infi GDR has result were not good. I don't know if how to get Infi GDR. It's not coming. So this was because GDR, Europe market. So this on this day, the Infi GDR, the Infosys, which have their business in Europe, the results were not good. The satisfactory results were not out. So Infosys Indian market and Infosys Indian stock opened 6% gap down. So that's the dependency. I'll read the line again. Indian ADRs are stocks of Indian companies that are traded on US stock exchanges. So yes, this is the correct explanation. So Indian stocks which are being traded on US stock market are ADRs, and Indian stock which are being traded in European market are GDRs. ADR can provide investors with insights into the performance of Indian companies and can also impact the Indian stock market, as ADR prices are closely linked to the price of their Indian counterparts. Exactly. Same goes to ADR stocks also. If any stock in ADR has not performed well, definitely the same Indian stock will also bleed or have the pain, or even the bull also, the upside also. If the same stock has performed wonderful in America, definitely the same stock in India will also see an up move. So we'll not talk only about bleeding and crash, we should talk about the bull run also. In conclusion, the Indian stock market is highly influenced by various global indicators. By keeping an eye on these indicators and understanding how they impact the Indian stock market, can make more informed decision and potentially earn better returns. So overall, I mean to say that the dependency, these all are the dependency, the interlink of markets with each other. So if you're drawing line, horizontal, vertical line, trend line and all, that's all okay, but to call yourself a trader, an intellectual trader, you should be aware that what are the things going on across the market. Imagine, see the big candles. People would have thought, no, this is just a correction, and would have made a topside position. Now see, it opens 6% gap down, all return gone. So those of you have returned in this 4 to 5 days, all gone in just one day. So what do you do with drawing trend line? None of the trend line, horizontal support, resistance will tell you this is going to open gap down. It will tell you the gap down, gap up things when you are connected with the global sentiments and you're referring the results and all these things. So that's it for the how global indices affect Indian stock market. The link of Indian stock market to global stock market. Anything further comes in this, I'll add on. So this video will be 3.1 or 4.1, I guess, whatever I have uploaded. This will be the continuation of that. I cannot go and add the same video in that one, but I would upload this as 3.1 or 4.1, whatever number is there. Any issues, you can email me on the Pathshala email ID. I'll give you in the description. Thanks for connecting.